Do not buy a single ounce of silver in February until you watch this video. I am deadly serious. If you click away right now, if you skip ahead, if you think you already know what happened in January 2026, you're about to make the most expensive mistake of your investing life. We just witnessed a 70% rally and a 30% crash in the same week. A month that saw silver touch $121.64 on Thursday morning and crash to $84.63 by Friday afternoon. The history books will call it Silver Thursday 2.0. The survivors will call it the month that separated the professionals from the amateurs. And the casualties? They're the ones who don't watch videos like this. If you want to survive February, if you want to know whether to buy at 85, whether to wait for 75, whether the bull market is dead or just getting started, you need to know who set the trap in January. You need to understand the exact sequence of events that took silver from $71 to $121 and back to 85 in 31 days. You need to see the smoking gun evidence that proves this was not a random crash. This was engineered. This was orchestrated. And this is going to happen again if you don't learn the lessons. Before we dive into the crime scene, before I show you the timeline, the catalysts, the technical setup, the February forecast, I want to see who is here with us, because we are building the smartest community in finance. We are the people who don't get their analysis from CNBC. We are the people who do the research, who read the data, who connect the dots. And I want to know, where are you watching from and what time is it there? Right now, pause the video and comment below. Are you in London, New York, Mumbai, Sydney, Tokyo? Are you watching this at midnight because you can't sleep thinking about what happened to your portfolio? Are you watching this at breakfast because you're planning your February strategy? Let the world see that the silver movement is global. I will be reading and replying to as many of you as I can in the first hour after this uploads. Do it now. Drop your location. Let's build this community together. Now let's get into the forensics. Because to understand what happened in January, you need to see it as three distinct acts. Act 1, the build-up, January 1st through 20th, when fundamentals still mattered. Act 2, the euphoria, January 21st through 29th, when speculation took over. And Act 3, the slaughter, January 30th through 31st, when leverage met liquidity and the market imploded. Each act had different players, different catalysts, different dynamics. And if you can't identify which act you're in, you will always be the exit liquidity for those who can. Act 1 began on January 2nd, 2026. Silver opened the year trading at approximately $71.59 per ounce. This was after finishing 2025 with modest momentum following a year that had already delivered 175% gains. The opening session saw a 4% pop to 74.51 as traders returned from the New Year holiday, but few anticipated what would unfold over the next 4 weeks. In India, silver had closed 2025 around 2,38,000 rupees per kilogram, roughly $70 to $72 per ounce equivalent, setting the stage for what would become the most explosive January in modern commodity history. And then the first catalyst hit. On January 1st, 2026, China officially implemented new export controls that reclassified silver from an ordinary commodity to a strategic material, placing it in the same category as rare earths and other critical minerals. The policy change, which had been telegraphed in late 2025, required exporters to obtain government licenses and effectively prioritized domestic consumption over global supply. Only 44 companies qualified for export licenses, down from over 100 previously. Let me explain why this matters. China accounts for 13% of global silver mining and 60 to 70% of global refining capacity, making its export policy a critical determinant of international availability. The timing was deliberate, as the United States and China remained locked in a trade war over tariffs and technology. Beijing signaled it would weaponize control over materials essential for solar panels, electric vehicles, and advanced electronics. Silver consumption in China's solar photovoltaic sector had surged to 29% of global industrial demand by 2024, up from just 11% in 2014, and the government had no intention of letting foreign buyers outbid domestic manufacturers. The impact was immediate. Shanghai silver premiums over London benchmarks widened from typical levels of 50 cents to $1 per ounce to $5 to $8 by mid-January, and it would eventually spike to $14 by month-end. This price dislocation signaled that arbitrage, normally a self-correcting mechanism, was breaking down due to export bottlenecks and inventory constraints. And then came the COMEX drain. During the first week of January, COMEX warehouses experienced a stunning 33.45 million ounce withdrawal in just 7 trading days, representing 26% of registered inventory disappearing in a single week. On Wednesday, January 7th alone, 3.25 million ounces were withdrawn with 0 ounces deposited, a pattern that had been accelerating since October 2025. COMEX registered inventory, the portion available for immediate delivery against futures contracts, had fallen to approximately 108 million ounces by mid-January, a 50-year low. Yet open interest for the March 2026 delivery month stood at over 100,000 contracts, representing claims on 500 million ounces of silver. The math was simple and terrifying. There were 378 paper claims for every physical ounce available in COMEX vaults. January delivery notices spiked to 48.8 million ounces, 4.1 times higher than January 2025. JP Morgan, historically both a short seller and accumulator of physical silver, issued delivery notices for 8.1 million ounces through 1,624 contracts on January 7th, 99% of that day's total activity. The backward rolling pattern that emerged, traders rolling from March, contracts back to January and February for immediate delivery rather than waiting, signaled urgent demand for physical metal rather than financial exposure. This inventory drain was not speculative froth. It reflected structural tightness. The global silver market had been in deficit for 5 consecutive years, with cumulative shortfalls from 2021 to 2025 totaling approximately 820 million ounces, largely covered by drawing down above-ground inventories. The 2026 deficit was projected at 200 million ounces, and China's export clampdown meant that the Western world could no longer rely on Asian refined silver to plug the gap. During this first phase, the rally was supported by genuine supply-demand fundamentals. Silver's price progression during Act 1 reflected disciplined buying rather than manic speculation. January 1st through 5th, $71 to $77 range, consolidating 2025 gains. January 6th through 12th, breakout to 80 to 84 as COMEX withdrawals accelerated. January 13th through 16th, first test of all-time high territory at 87 to 93 after hitting 93.75 on January 14th. January 15th, pullback to 90 after Trump delayed critical mineral tariffs, triggering profit-taking. January 20th, stabilization near 95 as the market entered consolidation. The gold-silver ratio, which had started January around 60 to 1, began compressing toward 58 to 1 by mid-month, a signal that silver was outperforming gold, but not yet in bubble territory. This was the phase where smart money was accumulating. This was the phase where institutional buyers were building positions based on fundamentals. This was the phase where if you bought, you were buying for the right reasons. And then Act 2 began. Between January 21st and January 29th, silver's rally transitioned from a fundamentally driven bull market into a speculative mania characterized by parabolic price action, extreme positioning, and classic signs of exhaustion. The metal added $26 in 8 trading sessions, with the steepest gains concentrated in the final 5 days. Silver broke above $100 per ounce on January 23rd for the first time in history, crossing a psychological threshold that triggered algorithmic buying and media coverage that sucked in retail speculators. The move from 90 to 100 occurred in just 10 days. The jump from 100 to 110 took only a single trading session, a pace that underscored the intensity of buying demand. By January 26th, silver tested 117.69 intraday before pulling back slightly. The daily candle on January 26th printed a shooting star pattern, a long upper wick signaling rejection at higher prices and a potential reversal signal, but the pattern was ignored in the heat of the moment. Technical analysts noted that silver was trading more than 100% above its 200-day moving average, a level of overextension that exceeded even the 2011 bubble. And then came the catalysts that sent it parabolic. On Tuesday, January 27th, President Trump accelerated the dollar's decline with explicit verbal intervention. Asked by reporters whether the dollar had fallen too much, Trump responded, and I quote, "No, I think it's great. I mean, the value of the dollar, it's doing great." The dollar index immediately fell to a session low of 95.566, its weakest point since February 2022. This comment was interpreted by markets as a deliberate policy shift toward competitive currency devaluation, a move historically associated with the Plaza Accord of 1985, and more recently with central bank currency wars. For precious metals traders, Trump's statement removed any doubt that the administration would tolerate or even encourage dollar weakness to boost manufacturing competitiveness. Silver surged $7 that day, the largest single-day gain since January 2nd, 1980. On Wednesday, January 28th, the Federal Reserve held its 2-day FOMC meeting and announced its decision at 2 p.m. Eastern Time. The committee voted 10 to 2 to maintain the federal funds rate in a range of 3.5 to 3.75%. Pausing after 3 consecutive quarter-point cuts, totaling 75 basis points. The FOMC statement removed previous language indicating that risks were weighted toward labor market weakness rather than inflation, suggesting a higher for longer bias. But markets interpreted the hold as dovish neutral. Powell left the door open to rate cuts if inflation cooled or the labor market weakened, and he avoided committing to a prolonged tightening cycle. Silver rallied $6 in after-hours trading following Powell's press conference, breaking above 115. By January 28th through 29th, the Shanghai silver premium over COMEX benchmarks had exploded to unprecedented levels. Chinese spot silver contracts traded above $125 per ounce, a $12 to $14 premium over New York prices, as domestic buyers bid aggressively for physical metal. This divergence, which had been widening gradually since early January, accelerated sharply as China's Lunar New Year holiday, scheduled for February 16th through 23rd, approached, and buyers sought to lock in supply before the Shanghai Futures Exchange closed for a week. The premium dynamics revealed a critical market dislocation. Arbitrage was not functioning. Under normal conditions, traders would buy cheaper silver in New York or London and ship it to Shanghai to capture the spread. But China's export licensing regime, combined with tight COMEX inventories and long shipping times, meant that arbitrageurs could not move metal quickly enough to compress the gap. And then came the retail mania. On Monday, January 26th through 27th, the iShares Silver Trust, SLV, recorded its largest single-day inflow in history, $171 million, nearly double the $93 million record set during the 2021 Reddit squeeze. Trading volume in SLV surged to $40 billion, exceeding NVIDIA's $23 billion, and reflecting a dramatic shift in retail attention from technology stocks to tangible assets. Vonda Research, which tracks retail investor flows, noted that silver buying was more vigorous than the traditional AI trade, with SLV volume running 11 times its normal rate compared to NVIDIA's sevenfold increase. This was not institutional rebalancing. This was speculative fervor from individual investors piling into a momentum trade that had gone vertical. On January 29th, silver opened Asian trading near 118 and surged to $121.64 in early New York hours, eclipsing the 1980 high of $49.45 and establishing a new record. The gold-silver ratio compressed to 46.79 to 1, the tightest since April 2011. Citigroup published a research note calling silver gold on steroids and projecting a $150 target within 3 months, citing Chinese buying momentum and dollar weakness. For a brief moment, at 8:45 a.m. Eastern Time on January 29th, silver traded at $119.47, a price that represented a 272% gain year over year and a 65% gain month to date. Social media was flooded with posts celebrating the Silver Squeeze 2.0 and comparing the rally to GameStop. Retail traders on Reddit and X posted screenshots of six-figure gains. Silver mining stocks like Hecla Mining and Coeur Mining surged 40 to 60% month to date, outperforming even the metal itself. And now I have to ask you a hard question. I need you to be honest with me and with yourself. When silver hit $121 on Thursday morning, January 29th, what did you do? Did you sell? Did you take profits? Did you recognize that a 70% move in 4 weeks was unsustainable? Or did you buy more thinking it was going to 150? Did you see 121 and think, this is just the beginning? Pause the video right now and comment below. Type, I sold or I held. Let's learn from each other's psychology. There's no shame here, only lessons. Because understanding your own behavior in that moment is the difference between being a trader and being exit liquidity. Do it now. Tell me what you did. And then, overnight, everything changed. On the evening of January 29th, President Trump teased that he would announce his nominee for Federal Reserve Chair the following morning. Speculation centered on Kevin Warsh, a former Fed governor from 2006 to 2011, who had served during the 2008 financial crisis and was perceived as more hawkish than alternative candidates. Bloomberg reported overnight that betting markets gave Warsh a 94% probability of being selected. On Friday, January 30th, at approximately 7 a.m. Eastern Time, Trump officially announced Kevin Warsh as his nominee to succeed Jerome Powell when Powell's term expired in May 2026. In a Truth Social post, Trump wrote, I have known Kevin for a long time, and I firmly believe he will be one of the great Fed chairmen, perhaps the best. The algorithm didn't wait for analysis. It reacted instantly. The dollar spiked. Yields exploded, and the easy money trade died in seconds. The market realized that with Kevin Warsh, the era of rate cuts was over before it even began. But while the political shock was hitting the front door, a financial disaster was sneaking in through the back door. Real interest rates, the nominal rate minus inflation expectations, jumped, increasing the opportunity cost of holding non-yielding silver. But that was only half the story. Compounding the pain, Microsoft reported earnings after the close. on January 29th that sent its stock down 10 to 11% on January 30th, the worst single-day decline since March 2020. Despite beating revenue estimates, Microsoft warned that its Azure Cloud division's growth rate was decelerating and that operating margins in the fiscal third quarter would face pressure from ballooning capital expenditures related to artificial intelligence infrastructure. The Microsoft sell-off triggered a broader risk-off move across U.S. equities. The S&P 500 fell 1.8%, and the Nasdaq Composite dropped 2.5%. But the real damage occurred in the margin call cascade that followed. Hedge funds and family offices that had run leveraged long positions in both technology stocks and precious metals faced simultaneous losses, forcing them to liquidate profitable positions to meet margin calls on losing ones. Gold fell 6% to $5,000 per ounce, but silver, smaller, thinner, and more leveraged, collapsed 31%. The selling was indiscriminate. Algorithmic trading systems that had chased momentum on the way up now amplified the decline on the way down, triggering stop-loss orders that cascaded into further liquidations. At 6 p.m. Eastern Time on January 29th, the CME Group announced an 18% increase in initial margin requirements for silver futures contracts, effective immediately for the January 30th trading session. This move, similar to the Silver Rule 7 imposed by regulators in 1980 to break the Hunt brothers' corner, forced traders to either post additional cash collateral or close positions. For a trader holding a standard 5,000-ounce silver futures contract, the margin increase meant an additional $10,000 to $15,000 in collateral per contract. Leveraged speculators who had bought at 115 to 120 and were already underwater suddenly faced margin calls they could not meet. The result was a forced liquidation wave that hit the market like a freight train at the 9:30 a.m. opening bell on January 30th. Look at what the brokers did. Owanda. Japan didn't just watch the crash, they panicked. They slashed leverage limits by 75% overnight. Why? Because they knew their clients were about to be wiped out. They were trying to stop the bleeding, but for thousands of traders, it was already too late. The margin calls had already been triggered. In cryptocurrency markets, where silver-linked derivatives trade with leverage as high as 50 to 1, the carnage was swift. Cryptocurrency exchanges reported $70.52 million in liquidations on January 30th, primarily from long positions in silver-pegged tokens and futures contracts. And then silver opened at 9:30 a.m. Eastern on Friday, January 30th, and entered freefall. Within hours, the metal plunged from overnight levels near 117 to an intraday low of $84.63. A 31% collapse that represented the worst single-day decline since the Hunt brothers crisis 46 years earlier. Some trading platforms and intraday data captured wicks as low as 73.86 before a late-session bounce stabilized prices. But the crash extended far beyond Wall Street. In Rajkot, India, a major hub for silver trading, 44 firms declared insolvency on January 30th through 31st, unable to settle 3,500 crore rupees, approximately $420 million, in liabilities. These traders had sold silver short, betting that prices would stabilize after the 2025 rally, and confident that silver would not breach 1,25,000 rupees per kilogram, about $150 per ounce equivalent. When silver exploded past that threshold, the valan, the local term for the gap between the trader's selling price and the market rate, ballooned to catastrophic levels. An emergency meeting convened on Saturday night, January 31st, where the 44 traders admitted their inability to settle debts and effectively surrendered to the market. Some shuttered their shops and fled, leaving counterparties across Ahmedabad, Indore, and Dubai scrambling to calculate their exposure. Paresh Dhanani, a local Congress leader, told the print that the reported 3,500 crore figure was very less, and that the minimum loss is around 10,000 crore, $1.2 billion, in Rajkot alone. The crisis illustrated how volatility in global markets can destroy regional economies built on leverage and margin trading. This proves that the January crash didn't just hurt the bulls who bought at 120. It destroyed the bears who shorted thinking it would never go that high. This was a liquidation event that killed both sides. Silver closed January 31st at $85.23, up 18.77% for the month, despite the catastrophic final 48 hours. The Wall Street Journal headline on January 30th captured the sentiment: silver prices crash. 31% and second worst day on record. In dollar terms, Friday's crash was the biggest daily decline ever. Despite the plunge, the precious metal wound up 12% higher in January. Now let's talk about February. Because the January monthly candle closed as a textbook shooting star or long upper wick pattern, a reversal signal characterized by a small, real body near the opening price, a minimal lower shadow, and an extended upper wick representing rejection at higher levels. This pattern, when formed after a parabolic rally, historically signals exhaustion and impending consolidation or correction. January 26th also printed a shooting star on the daily chart, a signal that was ignored in the Euphoria but proved prescient within 96 hours. Analysts noted that silver's extreme overextension, trading more than 100% above its 200-day moving average, created conditions similar to April 2011, when silver peaked at 49 and subsequently fell 35% in 2 weeks. The support levels to watch in February, 80 to 85, tested on January 30th through 31st. Former resistance becomes support, 75 to 78, the 50% Fibonacci retracement of the January rally, 70 to 72, the January opening range. Loss of this level would signal deeper correction. Resistance levels, 95 to 100, psychological round numbers. Reclaiming 100 would restore bullish momentum, 110 to 115, prior consolidation zone before the final parabolic move. 121.64, the all-time high, unlikely to be tested in February absent new catalysts. And here's where it gets worse. Silver's seasonal performance in February is among the weakest of the year. The 10-year historical success rate for short positions is 80%. Short positions were profitable 8 of 10 years. The 7-year success rate is 86%. Recent trend from 2018 to 2025, silver declined in 7 of 8 February months. The February 20th through April 25th window, silver has declined 35 of the last 46 years during this period, a 76% frequency. Jeff Clark, editor of the Chart Report, points out that even during the major bull market in precious metals from 2002 to 2011, silver only traded higher during the February 20th through April 25th period 4 times. The seasonal weakness is attributed to post-January profit-taking, Chinese New Year holiday closures, Shanghai Futures Exchange, shut February 16th through 23rd, and reduced industrial fabrication demand in the Northern Hemisphere winter. Key dates for February 2026, February 2nd, Oanda. Japan's new silver leverage limits, 5 to 1 max, take effect, potentially triggering further forced liquidations. February 16th through 23rd, Shanghai Futures Exchange closed for Lunar New Year, removing Chinese demand from global markets. February 18th, FOMC minutes. From January 28th through 29th, meeting released. Markets will scrutinize language on future rate cuts. March 17th through 18th, next FOMC meeting. Earliest opportunity for Fed to adjust policy after Warsh nomination clarity. Kevin Warsh's Senate Banking Committee hearings will likely occur in February through March. Confirmation is expected, but not guaranteed, with Democratic senators led by Elizabeth Warren vowing to oppose and some Republicans like Tom Tillis demanding an end to the DOJ investigation into Jerome Powell before supporting any nominee. The investment community is divided on silver's near-term trajectory. The bullish case says a rebound is expected. Peter Brandt and Marko Kolanovic, both veteran traders who correctly predicted the January 30th crash, now see a short-term bounce as probable. Kolanovic tweeted, "Despite my recent criticisms of silver, a bounce might be on the horizon, given the significant drop. Brandt expects a rally to relieve oversold conditions before a final capitulation that eliminates speculative excess, paving the way for sustainable gains in late 2026 or 2027. Citigroup's pre-crash $150 target within 3 months cited structural deficits and industrial demand. Post-crash, Citi has not withdrawn the call but acknowledged near-term volatility. The structural deficit thesis. The global silver market remains in its 5th consecutive year of deficit, with 2026 projected at 200 million ounces. The bearish case says deeper correction ahead. Bank of America analyst Michael Widmer estimates fundamental value around $60 per ounce, arguing that current prices are speculation-driven and that industrial demand, especially solar, likely peaked in 2025. Buffet sees prices mean reverting towards 60 to 70 in Q1 to Q2 2026. Positioning remains crowded. Despite the January 30th liquidation, open interest in silver futures remains elevated and speculative long positions have not been fully flushed out. A final washout that eliminates weak hands could drive prices into the 70s. Seasonal weakness plus Fed hawkishness. The combination of February's bearish seasonal pattern and the Warsh nomination reducing rate cut expectations creates a hostile macro environment for non-yielding assets. Most analysts expect February to be a consolidation month with a downward bias, trading in a $75 to $95 range with episodes of volatility. March through April, seasonality is more favorable, and if silver can hold 75 to 80 support through February, a retest of 100 to 110 becomes plausible in Q2. Now that you have the full picture, now that you understand the 3 acts of January, now that you know about the China export controls, the COMEX drain, the The Trump weak dollar comments, the retail mania, the Warsh nomination, the Microsoft margin calls, the Rajkot insolvency, the shooting star candle, and the seasonal weakness. I want to know, what is your plan for February? Are you buying the dip at 85? Are you waiting for 75? Are you sitting in cash until the seasonal weakness passes? Are you accumulating on a schedule regardless of price? Give me your price target in the comments. Tell me your strategy. And if this deep dive saved you money, if understanding the forensics of January helps you navigate February, hit that like button right now so YouTube shows this video to more investors who need to see it. The bull market is not dead, but the easy money is gone. February is for accumulation, not speculation. February is for the patient, not the greedy. February is for building positions in tranches, not going all in on leverage. The weak hands are washed out. The tourists are gone. What remains is the volatile two-way market that precious metals bulls forgot existed. For those with conviction and capital, Friday was the opportunity of the decade. Subscribe to this channel, turn on notifications, because we are tracking every move, every catalyst, every technical level through February and beyond. I'll see you in the comments, and I'll see you in the next briefing when we break down the first week of February. Stay sharp.